Hello viewers, welcome back. So in the last session, we understood the movement of inventory. So with respect to the closing stock, and we also saw the a simple formula for us to arrive at the closing stock and how the closing stock impacts depending on the movement of your inventory into your organization, out of your organization, and also movement of inventory within your organization. Okay, so let's quickly see how the closing stock is arrived. So we have already seen that. Let me just quickly share my screen. So we will understand how do you arrive at the closing stock. Okay, so the amount of inventory a business holds at the end of the reporting period is basically what is the value that you are going to arrive at as the closing stock value. And also we saw how we arrive at the closing stock quantity. Okay, so now one, if there is any opening balance, we saw the formula that opening plus inward minus outward will be the result of your closing stock. So whatever quantity you are purchasing, okay, and minus the quantity that you are selling, okay, the balance quantity that is left at any given point in time, right? So generally the valuation of the closing stock that normally or traditionally you do at the end of the financial year to arrive at the value of the stock that you are holding, which is going to form part of asset of the organization. So basically your closing stock are those inventories which are unsold on the date of your financial reporting. Okay, so the balance amount that is left with you, the unsold stock that is left with you, could be in the various form which we already saw in the earlier session. So it could be in the raw material form, it could be in progress, it could be in finished goods stage, and all those things, right? So this whole activity of your opening plus inward minus outward determines your closing stock at the reporting period, which is normally a 12-month period at the end of the financial year. Now comes the inventory valuation, right? So why inventory valuation plays a very important role? If you see, uh, generally, if you see, the idea of inventory valuation is for us to arrive at the value that we are holding. So if you see, inventory valuation is a monetary amount, very important aspect, the monetary amount that is associated with the goods in inventory at the end of the accounting period. The valuation is based on the cost incurred to acquire these inventories and get it ready for sale. And we know that, basically inventory, if you see here, inventory forms the major chunk of your current asset. Inventory valuation, to just repeat again, it is a process to place an accounting value on inventory's cost associated with the entity's inventory at the end of the reporting period. This is what I just mentioned. Okay, why inventory valuation plays an important role? If we take the current asset, okay, so the majority of your current asset value normally is going to have your inventory as your major value, which forms part of your current asset. Okay, so it is very important for us to arrive at the inventory value. Appropriate value or accurate valuation is very critical, because this value is the one which is going to represent in your profit and loss account and in your balance sheet. In one of our previous session, I had explained about how a closing stock uh, plays an important role, and why the closing stock is being represented on the income side of the profit and loss account, which is the credit side of it, and how the debit side of it goes to the balance sheet on your asset side, under your current liability. Okay. So improper, supposing if the valuation of the inventory is not done properly, we can't say that you have to do 100% accurate. As much as possible, we have to get to the near accuracy of your inventory valuation. Now what happens, what is the implication if there is an improper valuation of your inventory? The impact is going to be on the profitability. Okay. So, which means basically, if you are overvaluing your inventory, then your profitability is going to go up, and eventually you are going to pay more taxes. If you are undervaluing your inventory, then your profit is going to come down, wherein you will pay lesser taxes, but then you have your shareholders who are looking forward for a better performance of your organization. So the inventory valuation plays a important role. Let me just quickly give you a simple example for us to understand how overvaluing of your inventory or undervaluing of your inventory is going to impact your profitability, right? Let us take a simple example. Especially again, this will give you more clarity for the beginners. So I'm going to take a very simple example to demonstrate the impact on your profitability. So let us say you have purchased goods worth 1 lakh. Okay. So now the moment you make this purchase, and let's say it is on credit from ABC and company, you have made a purchase of 1 lakh on credit. So this transaction, how is it going to reflect in your financial statement? So if you see, we have this two financial statement. You take this balance sheet, okay, and then you take this profit and loss account. Okay, so this is our expenditure side, which is my debit side. This is my income side, which is my credit area. Similarly, in my balance sheet, I have this liability, which is my credit, and asset, which is my debit. So this transaction, the impact on the financial statement is very simple, right? So you are going to capture purchase here as 1 lakh, okay, which is the debit, and the credit is going to go under your sundry creditors, where your party is ABC and company, which is 1 lakh. Okay, so the debit and credit part is taken care. Okay, now let us say you have sold 50% of your item at 20% profit. Okay, so which means your sales value is going to be 60,000, right? You are sold for 60,000, which is basically your 50% of your item. Okay, and let us assume this is the only transaction that has happened in your company for the entire year. So now basically you have to arrive at your closing stock. Now this is where you are going to now value your closing stock, right? So how do we value the closing stock? So if you see, the example that I've taken is we have sold 50%, okay, which is my 1 lakh minus 50% of my stock is gone out by way of my sales, right? So that means 50% of the cost of my product. This is my purchase cost, and this is the cost of my goods which is being sold. Okay, so now the balance that is left with me is 50,000. That this is basically a closing stock, right? It's very simple for us to understand. Now when I am valuing my closing stock, right? So taking this very simple example, now I know that my closing stock on hand at the end of the financial year is 50,000, right? So now we have to see whether we have made profit or no, right? So I'm going to add up this. So it's going to show me here 1 lakh 10,000, okay? And on the debit side it is 1 lakh. So the balancing figure is going to be my gross profit, which is my 10,000, right? 1 lakh 10,000. So this is the profit that I've earned, which is actually, like I mentioned, it is 20% on the cost of goods that I've sold. So 20% on 50,000 is 60,000. That's how I made a sale of 60,000, right? So now it says that your gross profit is 10,000 rupees. Okay. Now let us take a weird example, right? Uh, Now, supposing instead of me considering actually the cost of my goods sold to arrive at my closing stock value, let's assume that by mistake, what I'm going to do, I'm going to say my purchase of my goods is 1 lakh, okay, minus my sale 60,000. Rarely you will do this, but then I'm just showing you what is the impact on your profitability. 60,000, right? So now I'm going to say, okay, I'm having stock worth of only 40,000. So instead of 50,000, let us say I go and make this as 40,000 as my closing stock, right? Now my closing stock value, the total of my income side has become 1 lakh, right? And my purchase cost is anyhow, it is 1 lakh. Now here, if you see, okay, so the net result of this activity gives me 0 GP. Is this the right thing? Now, assuming that there is no other indirect expenses, okay, so then we have in the earlier when you had valued your closing stock, we had valued it correctly. So it said that yes, I made a profit of 10,000 rupees, which is 20% on my purchase cost. Okay, in this case, because now what I'm doing, I'm undervaluing my closing stock, right? So for whatever reason, right? So now my GP is showing 0, which is not the case, right? Similarly, now instead of taking my actual cost of my closing stock as 50,000, let us assume that I'm going to overvalue my stock as 55,000. Okay, if I'm going to overvalue. Now, this is a simple case, right? So we will not have any confusion. But then when you deal with multiple items, multiple purchases, multiple sale is where the complexity is going to come. Okay, so first let's quickly understand. So if I make this as 55,000, now what is going to happen is my income is now going to be 1,15,000, right? And my GP now, it is going to now show my GP now as 15,000. Okay. So which means I have inflated my profit by 5,000 rupees because of my wrong inventory valuation, right? So undervaluation, whatever actually you have earned a profit, but then it is showing you a zero profit. Proper valuation is giving you the right profitability which you have earned. Overvaluation is going to give you inflated profit, which is what we saw in this example, that it is inflating your profit by 5,000 rupees, right? So that is where the valuation of inventory is going to play a very important and critical role. Now, see, valuation of inventory becomes very simple as long as there are two criteria. So one of the criteria is that let us say that you have this simple activity, which is very, very rare in any business. So mentally, you can actually calculate your inventory value and then you can capture the inventory value. The other easy scenario is that let us say that you are dealing in multiple products, and all those products that you are dealing in the entire year, right? So you have procured, just let's take an hypothetical example. In the entire year, let us say you are purchasing these items at the same rate, right? So which means basically, let us say uh, first time on some date, okay, you have purchased 100 numbers into 10 rupees. Let's take a smaller exam value so that mentally we can calculate. So the purchase cost is going to be 1,000 rupees, right? The second instance, you have purchased 200 numbers again at 10 rupees. So this is 2000 rupees. Okay. The third instant, again, you have purchased 100 numbers, okay, at 10 rupees, which is again 1000 rupee. Okay. Now, in the fourth instance, let us say, now this is your purchase, which means basically it is going to add your inventory quantity and also your value. Okay. The fourth instance, let us say I have sold, okay, which is going to now reduce my this thing. Let us say I have sold 150 pieces at uh, 12 rupees. Okay. So now this is going to be, uh, let's say take as 20. Okay. So you have sold for 3000 rupees. Okay. So this is your sale. So you sold at 20 rupees. Now, if you have to arrive at your closing stock, right? So how are we going to arrive at the closing stock is very simple, right? So my total purchase is 400 numbers, right? So 400 is my inward minus 150 is my outward, right? So now I am left with 250 quantity, okay, 250 numbers. So what is the rate that you're going to apply? What is the rate that you're going to apply for you to arrive at your closing stock, right? Since my all the purchases that I have made has a uniform cost or a single rate of 10 rupees on all my multiple instances of purchase. So whatever is the stock left at the end of the financial period, I have arrived at my closing stock quantity. Now it is very simple. I am going to say my cost is actually 10 rupees, right? So now I'm going to say my closing stock value is 2500, right? Simple. But then again, this is not the case. In less than 0.1% for any business in a given period, financial period of 12 months, it's going to be a very, very rare case where you will have an instance as per this example just now we saw, right? So what is the challenge? The challenge is that, every time I purchase my item, there could be an increase in the rate of my item. There could be a decrease in the rate of my item, right? So for example, let me take the same example here. First time when I purchased 100 numbers, I purchased at 10 rupees, right? So which is my 1000 rupees. Now second time when I'm purchasing 200 numbers, right? So this has become 12 rupees. The cost has gone up, right? So now it is going to be 2200, right? So my cost is now 2200. The third time when I'm going to buy 100 numbers, right? So this has become 11 rupees. The price has dropped. Okay. So now 1100 is what is my total purchases cost. Okay. Now let us say again in the fourth instance, I have sold 150 numbers at, say, same at 20 rupees, which is I have sold at 3000 rupees. Okay. Now what is the closing stock quantity that I'm holding? The closing stock quantity that I'm holding is, yes, 250 numbers, right? Now the big question is, what is the rate that I'm going to apply? Because every time my rate has been changing. So what is the rate that I'm going to apply? Now, this is where the inventory valuation is going to play a very, very important role for you to adopt a method or a system of arriving at your closing cost rate per item, so that whatever is the rate that you're applying based on the inventory valuation method, which are prescribed and practiced across the world, the resultant rate is what you're going to arrive at this, and then you're going to multiply with the quantity that is lying with you, and then you multiply them and get the inventory closing value, right? So to how do we handle this challenge? To handle this challenge is what we have, three very prominent inventory valuation method, and out of that, two valuation methods are widely adopted, and one method, some of the statutory systems don't allow you to value your closing stock by using that particular method. So let us now quickly see what are the inventory popularly adopted inventory valuation method for you to adopt in your organization to arrive at your closing stock value. Okay. So inventory valuation method. So the first one, if you see here, is FIFO. All right. So FIFO is basically stands for first in, first out. So what do we understand by this? Okay, very simple. It says whatever product you have purchased first, it is assumed that you are selling that item first. So whatever came in first goes out first, right? So that's your FIFO method, right? And generally, what kind of industries or what kind of businesses can adopt these method is generally, that if you take a perishable goods item like generally in the food industries. Okay, so this is very important because of their limited shelf life and the perishability aspect of the goods that they are dealing in. The other aspect is basically where uh, the other way that you would want to do this is when the prices are going up, right? So what you would want to do is that when the prices are going up, whatever came in first, if you're selling first, then it is going to show you higher profitability, right? So that way, basically, like you will have your older stock in your this one, uh, with the low cost. Okay, because the older stock is basically is going out, which is in the low cost, in the thing, so that the profitability is going to go up. So the result of that is basically going to be your higher taxes, where it is almost like overvaluing your closing stock. Okay. um, so the other thing, see, this if you see, the valuation is done basically from a system point of view. Now practically, how do we handle is very, very important. Just for us to see the FIFO method, if you just walk into a departmental store and you just go to the bread section, so normally what you do, because when they arrange this bread, that the bread which is there in front is what is going to have a lesser shelf life, which means basically the expiry date is going to be shorter, and the bread which is inside is what is going to be the higher thing, right? So normally, the tendency is that you would want to put your hand inside and then take the bread, because that that will have a longer expiry date, right? So physically, how do you handle is a challenge, but then from the system point of view, when you apply this method of inventory valuation, like for example, Tally allows you to select the inventory valuation method that you would want to adopt for your inventory items. Now, by default, Tally has one, which is again, predominantly, largely adopted by majority of the industries, is what Tally is giving you by default. But if you want to change to another valuation method, there are provision in Tally where you can change it. So the moment you change the inventory valuation method in Tally to FIFO, then y- see, you are recording your purchase, sale, then purchase, or sale. So now, based on the sequence, so whatever material is coming first through your voucher entry, and when you make your sale, Tally is going to remove the quantity from that particular lot, the first lot. When you make the first sale, it is going to take from the first lot. Supposing if you have made 1 2 3 purchases, and in the fourth, which the example that I showed you, in the fourth, if you are selling, in the fourth step, if you are selling, say, let me take the same example, right? So I have purchased the first item at 100, then at 200, 300. Now the fourth thing, I'm selling 150, 150 numbers, right? So now if I apply FIFO method in Tally for this item, if I have sold 150, then what Tally is going to do, it is going to first remove 100 because that 100 numbers came in first. Okay, it is going to remove 100 from that item, and then the balance 50 it is going to remove from the 200 numbers. And so basically it is now going to say 150 numbers at 12 rupees you have stock, and 100 rupees, sorry, 100 numbers at 11 rupees you have stock. And that is how Tally will calculate your closing stock value based on your FIFO. So we will see the other method, and then we will come and take an example, and we will see how the system is going to compute your closing stock value with all this complexity that you have in your variation in your rates on your multiple purchases. Okay, so this is how the calculation is done from the system's point of view. Okay, the second valuation method is LIFO, right? So LIFO again stands for last in, first out. So you would have understood, right? So what in this method, what the system will uh, do, or how the system will compute your closing stock value is whatever came in last will go first. Okay, so if you see the example says 1, 2, 3. Okay, so 1, 2, 3. So three came in last, but then when you are moving it out or when you are selling it, okay, three will go first. So that is why it says last in will go first. So 1, 2, 3 will become 3, 2, 1. But in the case of FIFO, it is in the same sequence. The material which is coming is moving out. So 1, 2, 3, 1, 2, 3. Right. So now the third, so I hope you have understood. So again, if I can just quickly pick up the same example here, what it is going to do, so 150 I have sold, right? So now if I apply LIFO valuation method, then what is going to happen? So instead of removing 100 from the first lot, because I've sold 150. So under LIFO, it is going to remove first 100 numbers from here at this particular rate, and the balance 50, it will remove from here, and it is going to now going to give you 150 is balance that you are having here. The value is going to come here, and your first lot will remain as it is. Okay, so this is how it is going to value your inventory under LIFO system. Okay, the third, which is the popular method, is the average cost method. Now, this is the default method that Tally adopts in the software, where by default, all your items are going to be valued using your average cost method. So, how do you arrive at the average cost method? It's very simple. So average cost, you will arrive at the average cost by taking the total cost of inventory that you have received as on date. Okay, which is let's say if you are doing the inventory valuation on 31st of March, so it is what is the total value of those inverts that has happened for your entire year, and it will divide by the total unit of inventory, that is the total numbers. Okay, numbers or kgs or liters, whatever is the unit. Okay, so total value divided by total inward quantity, the answer or the result of that is what is going to be your average cost of your item. And now, taking that cost, it is now going to multiply with the quantity that is left with you and arrive at your inventory value, which is as per the average cost method. Okay, so taking this example, average cost, how it is going to do. So 150 I have sold, right? So now, very simple, it is going to add up this all item. Okay, so it will take the total cost of this item is 4,300. 300. So it will take 4,300 divided by 400, whatever is the amount, that is going to be my average cost per item, and the stock that is left with me, which is the 250, right? So 250 is the closing stock that I'm having. So once you arrive at the value as per the average cost, so 250 into your average cost is multiplied, and your average value of your inventory based on the average cost is arrived. So these are three broadly accepted and practiced inventory valuation methods, which many companies follow. Like I said, average cost method is very very uh, popularly used inventory valuation method. So we will take the same example what I showed you, and then I'm going to show how, by applying different valuation method, how the closing stock value is going to differ based on the three methods that you have adopted. And we will see what is the variation in the value, and how you can realistically take those values, which is the right, or which is the proper value which you feel is the right valuation method, which is a near accurate valuation method, is what basically you wanted to see. So we will take this example and then we will see. So let us take the same example that we saw, and arrive at our closing stock value using these three methods. Okay. So the first one, so I said the first item I have purchased 100 numbers at 10 rupees, so 1000. Then 200 number as 12 rupees. Okay, there is a mistake here. It has to be 2400. So 12 into 200, 2400. Okay, and the third item that I purchased is at 11 rupees. So first let us take my total cost of purchase, right? So my total cost of purchase is 4500. Okay. Now let us now take the three methods, right? So uh, let's say that I want to arrive at my closing stock. Okay. By using the three method. Okay, let us see what is the value difference that you are getting by using three different method, and then whatever is the ideal method that you would want to use is what you can use for your organization. Okay. So I'm going to say, if I apply FIFO, what is going to be my value? If I apply LIFO, what is going to be my value? And if I'm using average cost method, what is going to happen? Okay. Now, so first, let us again take what is my total inward. Okay. So 100, 200, 300 plus 100. 400 is my total inward quantity. Okay. So simple formula for you to arrive at your closing stock quantity first is that you will say inward is 400 minus outward is 150. So your closing stock that you are having is 250, irrespective of what is the valuation that you're going to apply. So 250 is your closing stock. Okay. Now the big question that we have is, if you multiply this quantity into rate. Okay. So what is the rate that you will get by applying these three method? Okay. First, let us take the FIFO method. Okay. So the FIFO method says first in, first out. Okay. So if I apply FIFO method, whatever came in first. Okay. So this 100 came in first, so I have actually sold 150 numbers. So this 100 came in first, so this is gone, my entire quantity is gone. So balance 50. Okay. The system will now remove 50 from this, which means now you are left with 150 in this lot, and you are left with the entire quantity in this lot. Okay. So this lot is basically, you have 100 numbers you have got is 1100, right? So that entire amount is there with you. And here now you have 150, which the cost is 12 rupees. So 150 into 12 rupees, it is going to be 1800. Okay, so your inventory value as per FIFO is 2900. Okay, this is your closing stock value. So let us apply LIFO, which is the reverse of that. So now here, what happens is that under LIFO, okay, I've sold 150. So 100 numbers at 11 rupees came in last. So that has to go out first, right? So this 100 is gone. Okay, so now this is there. Okay, now out of this 200, again 50 is gone. So balance that is left with me is 150, right? So 150 into 12 rupees is 1800. And now my first thing which came is still there, because that entire 100 at the rate of 10 rupees I am still holding in my stock. Okay, so 1000, right? So now my inventory value as per Lifo method is 2800. Okay, now how do you arrive at the average cost? Okay, so average cost, like the formula says. Okay, so what does the formula say? The formula says take the total cost of the goods of inventory as on the day when you're valuing your closing stock, divide that by total unit of inventory, and whatever is the rate, apply that rate to the available quantity with you as your closing stock. Okay, so what is my let me just write down here. So my total value is 4500. 4500 divided by the total quantity that I have received is 400. Okay, so 400 equals, so 4500 divided by 400 will come to 11.25. The rate is, this is your average rate of your item, of all your inward supply at the various rate. Okay, so 11.25. Okay, so what is the stock that is lying with you? You have 250 numbers. Okay, so 250 numbers. Okay, so 250, so let me take here 250 into 11.25 is what is your average rate. So your average closing stock value now is going to be I've already calculated. It is going to be 2812 rupees 50 paise. Okay, so this three valuation method, if you notice, gives you three different values, right? So again, if you see, this is 2900, which it is valuing your stock at a higher thing. This is 2800, which is less. And if you see the average is 2008. Now this, in this example, it is giving you, but when you have multiple thing, then the variation, see here, you're not seeing too much of a variation. But then when you have your actual stock where you apply this FIFO LIFO average, and the best part in Tally, you can actually compare. So one is that Tally has got the average cost, average valuation method as a default valuation method. Now you can do this what if scenario, right? So what if I value my closing, so one, by default it is average cost. If I value my inventory using FIFO, what is going to be my inventory value? If I'm going to value using LIFO, what is going to be my inventory value? So you can actually, compare them in the column. And that's the flexibility that Tally offers you. And there are other interesting valuation method which Tally gives you. And once we go into Tally, we will discuss about what are the different valuation method that Tally gives you for your MIS purpose or for your analysis purpose. We will see that when we get into Tally, right? So this way, you now see that Tally is, I'm sorry, in the using this inventory valuation method, you are getting three different values for your inventory valuation, right? And again, you really don't have to worry, which again I had mentioned, that you are maintaining your accounting books in Tally, financial book, and your inventory book also. So as you start capturing your inventory detail, whatever is the closing stock that is arrived at any given point in time, See, again, the advantage using technology is that you don't have to do this manually. We took this three simple example, so we are able to do it, pretty fast. Just imagine hundreds of items or thousands of items with hundreds of transaction. How much time it is going to take? Even if you are doing it in Excel, it is going to take a lot of time. But then once you have this in Tally, by click of a button, Tally is going to give you the closing stock of all your inventory item, whether it is 100 item or 10,000 item. You will get that value. Now that value will automatically fetched from your inventory book. It will post it in on your income side as your closing stock in your P&L account, and it will post it as your current asset in your balance sheet on your asset side. So the credit on your P&L account, debit on your asset side, right? So the double entry is also taken care. So that is what basically you can integrate your inventory book with your accounting book, so that you really don't have to arrive or get into this nuances of doing the inventory valuation method manually, or you don't even have to export that information into Excel and then apply all those things. Like I said, you have average method. And when we come to Tally, I will also show you how, if you want to change some item, you want to have average method, some item you would want to have FIFO method. Like I gave an example of generally a FIFO is applied for your perishable goods, and LIFO very rarely people use, but LIFO is applied on a non-perishable goods, right? Example that you can take is antiques, right? So the longer you keep, or you can take another example is your wine or your whiskey. The older the wine is, the older the whiskey is, the value of that item is going to go up, right? So whatever comes in, I mean, like LIFO, whatever comes in last you will sell, so that whatever item you have received first will remain in your stock. Okay, so it depends on what you want to do. So we will see how flexible Tally is for you to set up the valuation method, not as a globally for all your item. You can select which item you want, what kind of inventory valuation. Okay, so I hope this session would have given you clarity on uh, why inventory valuation is very important, and what are the methods of inventory valuation that are popularly adopted by businesses across the world. And in the next session, we will get into the introduction of inventory module in Tally. Okay, so thank you all for staying till the end. So see you all till the next session. Thank you very much.